Troy Gayeski is a managing director and senior portfolio manager at SkyBridge Capital. It's a firm with $8 billion under management. Troy, welcome once again to Fast Forward. You were not that long ago at the end of August. Quite a bit has changed, but quite a bit has stayed the same. It seems like renewed concerns once again about Europe, some concerns about what's going to happen with European banks today. That fear seems to have subsided. But how's the hedge fund industry looking at events in Europe and the U.S. right now?
Well, Lisa, I think, to summarize, hedge funds, as we were coming out of the end of QE2, were already looking forward, saying without QE2, there would be much less upside in risk assets and much more downside. Thus, hedge funds did cut some risk prior to the sell-off. When it became apparent that European difficulties were much worse than people expected, coupled with the fact that the U.S. economy, the growth was mediocre at best, despite all the policy efforts to goose it, hedge funds began to cut risk even more aggressively in August. So right now, I think the mantra for most hedge fund managers is lose as little as possible. Try to pick your entry points when there's an ultimate, end game in the European situation.
It sounds like a simple strategy, a little bit of the KISS method there, but I know it's not quite that simple to actually employ. And you and I were talking this morning. I mean, actually, hedging right now is a pretty expensive proposition, right? Volatility
Correct.
is high. Buying protection as a result is quite expensive. So what are they doing?
Well, I think the preferred route right now is to look at the investment-grade credit markets as well as the high-yield credit markets. And in those situations, I mean, I looked at it this morning. Investment-grade CDX is trading about 135 over. So you're not paying that much for protection at this stage of the game, although you're paying a lot more than you would have a month ago. Additionally, most people would say at this stage, bond markets are pricing in a much worse severe outcome than equity markets, meaning if you look at the Treasury market, if you look at high-yield bond spreads or investment-grade spreads. Thus, a more efficient methodology may be to use index futures or S&P, SPX and ETF to just short equities. If you don't get your timing right, it can be painful, but ultimately, most hedge funds expect equity and bond markets to converge to the downside.
And how much of a convergence? I mean, I was actually startled. You mentioned a number to me, which made me ask you the question twice. The S&P, in terms of downside, what are many managers talking about right now?
It's hard to pin people down to an exact figure, but we would say somewhere between 10 to 20% more downside. Now, whether that occurs this month and next month, which we do expect more pain to be priced in, as equity markets, particularly U.S. equity markets, come to grips with how severe the crisis is in Europe. And again, the fact that the U.S. is stumbling forward with no policy response on the monetary side or fiscal side. So we think there's probably 10 to 20% more downside over the next 3 to 6 months.
All right, 10 to 20%, that's quite a bit. But in that context, though, what types of funds should people be looking at? I mean, we talked a lot about mortgage-backed securities arbitrage the last time. That's still one you like.
Yeah, at SkyBridge Capital, we're still very bullish on prepayment-sensitive mortgage-backed securities. Fortunately, due to some of the noise around the Obama refinance plan, you had significant spread widening in August. And so the entry point today is almost as good as it's been at any time since at least late 2009, and that is a non-correlated strategy. So we really like the carry streams. We really like the potential for further price appreciation. Other than that,
like the tail funds, and because we've run out of time here, but I want to make sure we talk about the next two tail funds.
Correct.
And discretionary macro managers.
Yes, both of those tail funds are specifically in existence to make money when markets go down. Unfortunately, if markets don't go down, you're going to pay a negative carry, so you're definitely going to lose money. Macro funds, on the other hand, do have flexibility. So if markets continue to erode, they can make you some money, and then if markets ultimately rebound, they can switch their positioning. So both macro and left tail hedges are other strategies that people are looking at right now to add.
I'm going to call them the black swan funds. All right,
yeah,
thanks
the black
so
swan,
much. Exactly. Thanks so much, Troy. Always good to have you. That was Troy Gayeski of SkyBridge Capital.